Good afternoon, everyone, and welcome to today's briefing on fringe benefits tax. My name is Ali Suleiman, and I'm the Employment Taxes Partner at Pitcher Partners. Also, I think it's you should probably all congratulate yourselves. I hear there's over 1,000 registrants for the briefing here today, and to steal a line from one of my co-presenters, Eleanor, today, not quite Taylor Swift-esque, but in Pitcher Partners terms, it's a very good turnout and great to have you all on board. As we gather for this virtual event and are physically dispersed, let's recognise the various traditional lands on which we do our business today. I wish to acknowledge the traditional custodians of the land we work and live on and pay respect to the past, present and emerging generations. In today's online session, we will be providing you with an update to some of the FBT changes that have occurred during the past year, the year ended 31 March 2024, and reinforce some of the key fundamentals that everyone will need to bear in mind as they're preparing their fringe benefit tax return for the current year. In a subtle change to prior years, we've already sought some questions from you beforehand, and where possible, we've tailored or pre-tailored our presentation to incorporate the responses to those questions or incorporate that into our case studies. So thank you for those who have sent through their questions. It was quite useful. In today's presentation, I'll be joined by PJ Cheng and Elena Bogomolova, both extremely experienced practitioners that specialise not only in FBT matters, but also some of the other employment taxes matters, such as payroll tax, work cover and superannuation. Now, for those of you who've attended these sessions before, Eleanor will be very familiar to you and needs no further introduction, particularly with her extensive experience both at professional practice and as a regulator in a formal life. PJ has recently joined us and comes to us with over 15 years experience, both in the professional practice setting and in industry. So there'll be a bit of a tag team with the presentation today, where I'll be covering off on some of the basic concepts relating to FBT, some of the key dates and thresholds relevant to FBT, before handing over to PJ to discuss some of the recent developments and record keeping requirements. And of course, Eleanor will bring us home with some of the common issues we encounter with our clients. So hopefully there'll be some tips and traps coming out of each part of the presentation that you might find useful. Before we go into the meat of the presentation, it is worth pointing out that there has been quite a bit of ATO activity around employment taxation related matters recently. We've seen some targeted employer obligations audits or reviews, focusing on things like PAYG withholding, superannuation guarantee, and fringe benefits tax. These kind of reviews, they are targeting some of the employment taxes areas, but it is also consistent with the shift we're seeing from the ATO in terms of increased enforcement and increased debt collection actions, particularly in the post-COVID environment. Even recently, I had a client who submitted a large R&D claim, and as part of the queries on the R&D, they've decided to look further and do a little bit of a review on their general employment tax-related matters, including PAYG withholding and so forth, and their GST reporting. So there's quite a little bit of that follow-up action with the ATO at the moment. If we look at that lovely little graph on screen, the ATO have this estimate of what they think the total FBT liability for the economy should be. And based on that, they think that in the 2021 year, approximately 72% of FBT payments of all FBT payments were made and collected. That was down from 80% of the prior year. So it's an 8% swing. It means that they think that there's another 28% of FBT remaining unpaid, which is around $1.2 billion. That's what that estimate comes out to. Now, again, as I said before, that's a decline in compliance, if you like, compared to the prior year. And the ATO think that reflects some of the decline in benefits being provided in the post-COVID environment, particularly with economic disruptions that had occurred and people working from home and changes in work patterns, which might have meant less fringe benefits tax being offered. But at the same time, they also have a theory that given there are a lot of businesses experiencing hardship, financial hardship, perhaps there's a lot more in FBT underreporting and non-compliance. Tellingly, if you have a look at the ATO website, there's actually a comment, and they're not ashamed to admit it. It says from 2023, 2024, we'll be increasingly nudging employers via letters, emails, and phone calls check their obligations and to lodge their FBT returns if they have an FBT liability. So unashamedly, they are following up. As always with FBT, a couple of the largest benefit items are motor vehicles and expense payments, and so they're focusing, not unsurprisingly, on compliance with motor vehicles. They're also looking at record keeping. Now, in terms of motor vehicles, given it is the largest category, what are the types of things that the ATO see non-compliance in? It's where people typically report 100% business use, even though there is an availability for the vehicle to be used for private purposes, particularly the use of some exempt vehicles like the dual cabs and so forth, where you have a dual cab, it's automatically treated exempt and not considering whether the private use was limited. Other areas of focus include whether there's a valid logbook, or even if there is a logbook, whether that's representative of the business-related use of the vehicle. In terms of record keeping, again, the area that the ATO announced that they'll be focusing on is employee declarations, employee logbooks, evidence of employee contributions to reduce, obviously, the FBT payable, and whether if there are contributions, it's been properly also reflected in the income tax return. Probably the other point to note, and I alluded to that a little bit earlier, is that the ATO continue their data matching with third parties. So we've seen them seek information from VicRoads in the past on registration details. If companies have luxury vehicles registered, and whether those luxury vehicles have FBT being paid on them, and so matching registration to companies and so forth. They're now seeking information from novated leasing providers. They've got an increased data set of single touch payroll reporting, and as always, they're using BAS disclosures and taxable payment annual reports, the TPAR reports, to gather information on and to detect anomalies between the fringe benefits being reported and some of the other disclosures being made. And before we move on, I did touch on information sharing. It's always important to note that it doesn't end there. The SRO are not also ashamed to admit, they're making no secret of the fact that they often obtain information, particularly around things like contractors, from some of the disclosures made in tax returns. And often, if you've ever been part of a state taxes review, you'll notice that there are some questions where they haven't been able to line up some of the disclosures in an income tax return with what's been made with the state revenue officers. So something to bear in mind. So moving on to some of the basic concepts related to fringe benefits tax, or fringe benefits generally. What is a fringe benefit and how is it taxed? And it's probably important to note that it is a tax separate to income tax, and it is a tax paid by employers that relates to the benefits provided to their employees. The definition is very broad. As you can see there, it's in relation to an employee. It needs to be provided by the employer, or might be part of an arrangement provided by an associate of the employer in relation to a year of tax, and it is extremely broad, and it has to be in respect of the employee's employment. None of that has changed from previous years. It's the definition of fringe benefits. It's an extremely wide net, and then there are some specific exclusions to carve out things that might fall into it, and even the obvious things like salary and wages and bonuses prima facie fall in, but then there's a specific carve out for those things so that they're not double taxed. So if we move on, one of the other key aspects is that fringe benefits tax applies in respect of employment, and so we need to be an employee, and the definition of employee is tied to whether or not there's a PAYG withholding requirement on the payments. There is then an extended definition to capture things that are to capture benefits that are provided in lieu of a cash payment. So if only non-cash items are received, you can still deem to be an employee, on the hypothetical situation that if cash was paid, there would have been withholding. And so there's an extended definition of employee. In terms of sufficient or material connection, again, this is a really, really relevant area to the SME market space, the space that we operate in, because often there are people that are both that might be said to be employees in the business, and they may also be seen to be the shareholders and the owners of the business or the beneficiaries of a trust that's running a business. So there needs to be a sufficient and material connection, and so the facts and circumstances really need to tie it to be in respect of the employee's employment, and that's where the professional judgment's required to understand the distinction. In terms of, I said before, the definition of FBT is really wide. There's quite a few benefit categories there that you can see on the slide. You know, we've grouped them symbolically into those lovely little graphics. You know, car benefits, car parking fringe benefits, you know, debt waiver benefits in respect of, you know, loans that may be forgiven, loans which may not have benchmark interest rates and so on. And then there's the, you know, the housing related benefits, and then obviously the entertainment related benefits. So there's quite a, it's very broad, as I said before, and there's quite a few different benefit categories. And you might think, well, why is it so important to have so many different categories of benefit, or know the distinction between the different categories of benefit? And it's a simple thing, because often the different categories of benefit have different methodologies as to how you might value the ultimate tax payable. So, for example, a car fringe benefit, you may have access to things like the statutory method, where it's a flat 20% rate against the base value of the car. Whereas if the car wasn't, you know, an obligation of the employer, but it was the employee owned the car and was submitting expense claims as an expense payment fringe benefit, it may not get the same. You may not get the same taxable value outcome fringe benefits tax purposes. And we'll be running through some examples. Whether it's PJ or Eleanor, we'll be running through some examples talking to the different categories and their importance. In terms of what's the ultimate taxable value with FBT, again, it's once we've worked out that we have got a fringe benefit and what it's worth, then we need to consider, well, is there an exemption, you know, general exemption, such as the minor benefits rule, or whether it's a work-related item that gets specifically carved out, or whether there's a specific exemption, such as in-house childcare facilities, to determine what the ultimate taxable value of our fringe benefit is. One of the most common exemptions we actually do see is the minor benefits exemption for items that are low value and provided infrequently. And finally, if there is a taxable value and there isn't an exemption available, there might be a partial or almost a full reduction for things such as the otherwise deductible rule, and for any employee contributions that may be made towards the reduction of the benefit. And again, it will often make sense for employees to contribute towards the benefit, particularly when they're not at the top marginal tax threshold. So in terms of key dates, look, for those of you that have been involved in the FBT process, you know, most of these dates will remain familiar. The FBT year end remains unaltered as the 31st of March. And even the official lodgement dates remain unaltered. Key thing to note is if you don't use the services of a tax agent, your lodgement date is due on May 21 this year. And whereas if you do use the services of a tax agent, there's an extra month, a little bit more time to the 25th of June to get your FBT return in. On both scenarios, the payment of the relevant FBT liability is due on June 25. So, whilst this is probably, again, this has been running for quite a few years now, but always worth pointing out because of the significant penalty. If you are, part of an entity that's part of a large, substantial, significant global entity, and you are deemed to be a significant global entity, then there are significant penalties that can be levied for even being 1 day late in lodgement of your return, and that spans to over $100,000 for being late for each 28-day period. And as I say, if you are an SGE, be particularly mindful, be ahead of the game in terms of not only getting your information ready and doing your FBT return, but if you know you're not going to make the deadline, to get on the front foot and seek some extensions of time. So in terms of key rates and thresholds, I've probably said this for a few years now, that there's not a whole lot to update, and so I won't spend too much time on it. The FBT rate remains unchanged, and because it remains unchanged, a lot of those gross up factors and other things and thresholds have remained unchanged. What has changed is really with CPI. The benchmark interest rates moved up from 4.52% to 7.77%. Things like the car parking thresholds being indexed, and obviously some of those cents per kilometre rates for residual motor vehicles has been adjusted upwards as well. Well, it is time, opportunity to pass over to PJ, and he can talk to us about some of the recent developments in the FBT space.
Thanks, Ali. Good afternoon, everyone, and thank you for joining today's session. While there have been no major legislative reforms during the FBT year, the ATO and the courts have certainly been thinking about some of the more technical issues around FBT. Now, given that vehicle emission standard is a topical issue in Canberra at the moment, and there's a greater push towards electric vehicles, we think that this might be a good place to start. As advisors, we are seeing more and more employers and employees switching to electric vehicles as part of their company fleets, or employees using EVs as part of their novated lease packages. As a bit of a refresher, the FBT exemption on EVs has a 3-year window, and 2024 FBT year is the second year of that particular window. Some of the key takeaway points on these exemptions: the exemption only applies to battery electric vehicles, hydrogen fuel cells, and plug-in hybrids, noting that there's a sunset date on the plug-in hybrids. So as advisors, we're expecting to see more and more of these BEVs coming online ahead of the proposed end date of 31st of March 2025. Currently, there's no indication from the government on whether this 3-year exemption window will be extended. So we are hoping for some clarity in the upcoming May budget. So watch this space. Also, as a reminder on some of the fine prints surrounding the exemption, the car must be first held in use for the first time on or after 1st of July 2022, and that applies to second-hand vehicles as well. So if you have a second-hand Tesla and you've used that, and it was held and used prior to 1 July 2022, and it's been sold to the employer or the novated lease providers on and under sale and leaseback transaction after 1 July 2022, that exemption will not apply. The other point is that for the first retail sale price of the car, the value must be below the luxury car tax threshold for fuel efficient vehicles. Now, a couple of observations here. So in relation to new cars, we've seen some anecdotal evidence that some of the car makers, particularly the higher end brands, are dropping prices on EVs in order to meet this threshold, in order to, with the view of staying competitive with other brands. In terms of second-hand cars, the access to pricing information remains tricky, and really it's just reliant on internet search, car reports, or independent valuations to estimate that first retail price. Lastly, for this exemption to apply, the vehicle must fall within the definition of a car for FBT purposes. So it does not apply to motorcycles, e-bikes, or utes with carrying capacity of greater than 1 tonne. Now, a couple of important watch outs here, and we've received a number of questions on this front, and it's to do with RFBA. Even though the benefit is exempt from FBT, employers are required to calculate a notional grossed up taxable value of the benefit that's been provided, and needs to be included in the employee's reportable fringe benefits amounts for the year. We've had questions on how this has been calculated. The simple answer here is that you value the benefit that's been provided as if they're not exempt from, as if this exemption didn't apply. So you'll be using the statutory formula method or the operating cost method in calculating the notional taxable values of these benefits provided. Eleanor will touch on that in her tips and traps section. But back onto RFBA, employers should be aware that employees may be affected as a result of this disclosure in terms of to the extent of their means tested government entitlements, as well as other obligations like Medicare levy surcharge. From an employer's perspective, it's important that these amounts are calculated properly, recorded, and reported by payroll under the single touch payroll regime. The other point is that for employers in particular with novated leases, they can only claim notional interest and depreciation on EVs up to the luxury car depreciation limit. But in reality, your Novated lease providers should notify you when this happens and provide you with and withhold additional amounts from the employees as part of their salary packages. Now, over the past 12 months, there's still some confusion as to what kind of expenses will be considered as operating expenses when it comes to EV. And this has something to do with the fact that some new charges or expenses have been introduced as for EV usage. Even though there's introduction of those expenditures, the broad principles haven't really changed. So this slide is here to help clarify that particular issue. So what's in? So first of all is the road user charges imposed by the state and territory governments. And on last check, I think most of the state and territory governments have imposed that charge. You've got repairs and maintenance expenses, and that includes a replacement of battery. But caution needs to be have here. With battery replacements, it needs to if the battery enhances this the efficiency of the vehicle, that cannot be counted as repairs and maintenance expenses, but rather included in the cost price of the vehicle. So it's something to be aware of here. Then we look at electricity costs that's incurred to charge and run the EVs. To that end, the ATO has introduced a shortcut method for electricity costs incurred for charging at employees' residential premises, and we'll go through that shortly. Then you have insurance and car wash expenses. These are generally well understood. What about those that are considered separate benefits? Well, you can see on the slide here that car parking, toll expenses, as well as non-business accessories, they're commonly understood as part of in working through car fringe benefits that's been provided to employees. But what's slightly different here is that you've got GPS subscriptions and also home charging stations, and including the installation of solar panels supplying electricity into to that home charging station. Now, just going back to the electricity charging costs issue, the ATO has finalized and introduced a shortcut method to work out the cost of charging an EV at an employee's residential premises. Now, PCG 2024/2 is retrospective from 1 April 2022, but the choice to rely on this method resides with either the employer or the employee. What's interesting here is that in comparison to the draft version of this guidance, they've removed a reference to employers' premises and solely focused on the employees charging at employees' residential premises. So it's something to be aware of here. So what are the situations where the ATO will accept the use of this method? The first one is when you're working out the taxable value of the EV, where the exemption doesn't apply. So going back to the second-hand EV example that we previously mentioned, and in particular working out any of the post-tax employee contributions or the operating costs under the operating cost method. In the second scenario is when employers are working out how to reimburse their employees for EV-related electricity cost charge that costs incurred at home. And lastly, is being used to work out the notional taxable value of an EV for RFBA purposes, as we've talked about before. Again, a couple of important watch outs here. One is that PHEV, you can't use this method for PHEV or plug-in hybrids. And there's some record keeping requirements here. So primarily is around the distance, a record of the distance that's been traveled by the EV. Now, given the retrospectivity of the guidance, the ATO actually accepts employee declarations, odometer records, and especially in prior year periods, looking at service records. Turning our attention to employee travel. Now, you would have thought that after the John Holland case, the ATO and the ATO issuing tax ruling 2021/1 and PCG 2021/3, that the issue would have died down a little bit. The ATO ruling specifically deals with employee when would the employee transport expenses become deductible, whereas the PCG deals with the process in determining whether an employee is traveling on work or living at a location. So the general rules here are that if you're traveling for work, so in a home situation, that's generally non-deductible, as opposed to a traveling on work situation where it's between work locations, that's usually deductible. Where this line blurs somewhat is when multiple destinations are involved, such as the one that involves FIFO employees. And the Bechtel case tests that boundary a little bit further. In their case, like any other FIFO workforce, there's often the need for employees to travel from their home base to another airport or forwarding base, then onto the actual project work site. Now, without going through the specifics, it's safe to say that the fact patterns between John Holland and Bechtel are quite similar. But the key points being that both employees require interstate workforce to work on remote project sites. Employees are required to fly in from their home port to forwarding bases before being transferred to the remote worksite by chartered transport, where they're required to work for a continuous period before heading home. Now, John Holland and Bechtel both paid for the transfer cost between the forwarding bases and the project worksite. But the outcome in court rulings are quite different. Whereas John Holland was successful, Bechtel actually lost the case, costing themselves an additional $13 million in FBT liability. You may ask, what's the difference here? Well, the difference is where the employees are considered at work. In the John Holland case, employees are considered at work or rostered on as soon as they arrive at Perth Airport. So their onward journey, the transfer from the forwarding base, being Perth Airport, to their project work site, is done during work time. This, in contrast, Bechtel employees are only considered at work or rostered on upon their arrival at the project work site, which is off Curtis Island off Gladstone. So there's a small difference here, but the results, it's huge. The different results. There are different results here. Now, Bechtel has actually appealed, but it was actually the appeal has been dismissed by the full federal court, as a matter of fact, last Friday. Now, taking this away from the FIFO, the fly in, fly out context, this case actually highlights that employers need to be very cautious in setting out policies about on employee travel, what they consider to be employee travel, and the type of travel expenses that they're willing to fund or reimburse. Now, onto another issue with FBT ramification. And this is to do with TR 2024/3, which talks about the deductibility of self-education expenses incurred by an individual. Now, you may think that this ruling is actually just income tax based, but the fact that it has impact on how the otherwise deductible rule will be applied when it comes to self-education expenses. This ruling was first released in 2023 as a draft, but finalized and released back in February this year, with 38 examples to boot. Now, as a bit of a reminder, the otherwise deductible rule refers to the taxable value of fringe benefits provided being reduced to nil, to the extent that the employee could claim a deduction and had they incurred the cost themselves without being reimbursed. Now, as you can see on the slide here, the ruling sets out a couple of broad principles and a couple of exclusions in order to work out whether self-education expenses can be deductible for income tax purposes, and by extension, whether the otherwise deductible rule could apply had the expenses been reimbursed by the employer. So as you can see here, For the self-education expenses to be deductible, it has to be incurred in order to maintain or improve an employee's skills and knowledge, and in all likelihood increase their income from the income producing activities. The ATO and the Commissioner has actually gone further to say that self-education expenses will not be deductible if the cost incurred is to help an employee obtain new employment, or if the employee is not currently performing that income earning activity. So what does that mean? What's the key takeaway for employers in relation to this ruling? So first off is the connection to the current role. The employee has to be employed when the self-education expense incurred and reimbursed by the employer. So therefore, there's no coverage to former or future employees. Secondly, employers will need to inquire a little bit further into the types of self-education courses that are eligible for reimbursement, and they may need to be quite specific in this regard and may have to update their policies as a result. Now, I just want to finish off this section with some draft legislative instruments. So over the past 3 years, the Treasury has progressively released tranches of draft legislative instruments which is designed to alleviate some of the record keeping and substantial requirements for employers. So they've released 3 tranches, totaling 11 draft legislative instruments, but unfortunately, at the time of this seminar, they're still in draft stage. Now, it covers anything, quite a few areas, from relocation transport to otherwise deductible benefits and to private use of vehicles other than cars. But the running theme here is the same. It's to replace declarations which are often FBT specific and serve no other purposes from a compliance perspective. And they're trying to replace them with records which are typically generated through day-to-day business operations. The slide here is just to give you a bit of a preview of some of the substantiating documents that the ATO and the Treasury and ATO may be willing to accept for FBT going forward. Now, whilst we may be employees may be breathing a sigh of relief in terms of paperwork, there needs to be some observations that need to be made, or cautions that in relation to this type of draft legislative instruments. One, they're not having been finalised, so employers will need to collect declarations for the time being. And secondly, employees will need to think about the governance measures and procedures in capturing and maintaining these kind of documents. And you need to take into account not just tax, but also other legal requirements such as privacy requirements. Now, as you can see, even without any substantive legislative reforms, the FBT world is constantly changing, as shown by these recent developments. Now, together with the compliance activities that Ali mentioned earlier, compliance with FBT can be quite nuanced. With that in mind, Eleanor will now take you through some of the tips and traps in preparing your upcoming FBT returns. Over to you, Eleanor.
Thank you, Pijat. Hi, everyone, and thank you once again for joining us for this session. I will focus on discussing some risk areas and common issues which we see in practice. Thank you, everyone who sent through their questions. I will aim to address as many of your questions as possible. I will have to move through the topics fairly fast due to the time constraints. However, please reach out if you have any further queries. I will specifically focus on issues relating to exempt vehicles, valuations for car fringe benefits, classification of benefits, entertainment, car parking, and reportable fringe benefits and payroll tax disclosure. So let's start with exempt vehicles. It is common for our clients to provide to their employees various types of utes, panel vans, dual cabs with load carrying capacity either greater or less than 1 ton. I often hear that there is a perception out there that these types of vehicles are exempt. While the exemption is available, it is not automatic. It is subject to satisfying certain criteria and having appropriate substantiation documents on file. I'll refer to this exemption as the workhorse exemption. Broadly, for these types of vehicles to be exempt, their private use has to be minor, infrequent, and irregular. This term was clarified in a practical compliance guidance issued in 2018. So it's PCG 2018-3. This guidance is very useful as it shows the ATO view on the scope of this exemption. And what it largely comes down to is that to satisfy this exemption, among other criteria, the employee's private use should be less than or around 1,000 kilometers per year. This number is not set in stone, but it does represent an ATO view. Note that when determining a private use, for the purposes of this exemption, the travel between home and work is disregarded. So your focus is just on the private use other than home to work and business travel. When vehicles are treated as exempt under this exemption, it is advisable to have employee declarations on file for substantiation purposes. So what happens if vehicles don't satisfy the workforce exemption? Fringe benefit tax is payable on the private use of those vehicles. So the vehicles have to be valued for FBT purposes. At this point, it becomes very important to determine the vehicle's load carrying capacity. It is also known as payload. If the vehicle's payload is over 1 ton, it is a residual vehicle and has to be valued using a lower of operating cost or cents per kilometer method. For those vehicles, a reasonable estimate of business kilometers and total annual kilometers traveled should be sufficient. Vehicles which have a load carrying capacity of under 1 ton fall within the definition of car fringe benefits and should be valued using the lower of operating cost or statutory formula method. For car fringe benefits, if the car is used for business purposes, it is advisable to have a logbook to reduce the taxable value using operating cost method. If logbook is not available, the operating cost method can still be used, but the private use is considered to be 100%. Importantly, when determining the taxable value for car fringe benefit, home to work travel is considered to be private use. Remember, for determining eligibility to workhorse exemption, I said that home to work travel was disregarded. But for the purposes of valuing these vehicles as car fringe benefits, when workhorse exemption does not apply, home to work travel is considered private use. This is an important distinction. I usually suggest to clients that in their logbooks, they have 3 types of travel categories: business, private, and home to work travel. So this would assist in calculating the taxable value. Now moving on to other common issues with car fringe benefits. As I've mentioned before, there are 2 methods available to value car fringe benefits: statutory formula and operating cost method. Broadly, when using the statutory formula method, which is 20% of the base value of the vehicle, adjusted for days unavailable during the period. Take note of the definition of base value and what it includes and what is excluded from this value. So, for example, base value is inclusive of GST, luxury car tax, dealer delivery charges, and any non-business accessories, but exclusive of stamp duty and registration. Base value of the vehicle can be reduced if an employee provides his or her vehicle as a trade-in. Base value can be reduced by 1/3 when the vehicle is held for 4 years by the beginning of the FBT year. Days the car is available for private use can be reduced when the cars are in extensive repairs or if an employee has taken an extensive leave and surrendered their keys to the employer. When using operating cost method, you need detailed records of all operating expenses for the vehicle. If a vehicle is owned, operating expenses should include deemed depreciation and interest. If a vehicle is leased, lease charges should be included. Please remember document keeping requirements. A valid logbook and employer election to use operating cost method should be on file for substantiation by the time of lodgement of the return. A valid logbook is kept for a continuous period of 12 weeks, and provided there are no material changes in the circumstances, it can be used for the current year plus 4 subsequent years. When a vehicle is purchased through a hire purchase arrangement, you need to be careful that the vehicle is purchased by the employer and not by the employee, as shown in the example below. An employee enters into a hire purchase agreement to acquire $80,000 vehicle. Employer reimburses employee for hire purchase payments and car running expenses, which are around $30,000 per annum. So what type of benefit is this? For a car fringe benefit to arise, the car has to be owned or leased by the employer. In this case, the hire purchase agreement is in the employee's name, so it's not a car fringe benefit. As the employer reimburses the employee for the cost incurred, it is an expense payment fringe benefit. Taxable value of this expense payment fringe benefit is $30,000. If it was a car fringe benefit, the taxable value could have been $16,000 using the statutory formula method, being 20% of the base value of $80,000. Another area which is popular amongst our client and where we have received a lot of questions is entertainment. What is an entertainment benefit? It is defined very broadly and includes recreation and meal entertainment, as well as accommodation and travel to do with providing entertainment. So if an employer with Australia-wide operations has a Christmas party in Melbourne and arranges for their interstate staff to attend this party, the cost of entertainment benefits provided to the interstate employees would be the aggregated amount of cost of Christmas party plus cost of accommodation plus cost of travel. So please remember, this will be important when applying the minor benefits rule, and we will discuss this shortly. How do you determine whether an employment benefit, whether an entertainment benefit was provided? There is a very detailed ATO ruling on this. It's TR 9717. Broadly, you have to ask 4 questions. What type of food is being provided? When the food and drink is being provided? Where the food and drink is being provided? And why it is being provided? The purpose of these questions is to distinguish when meal entertainment and when sustenance has been provided. It is important to differentiate between these 2 concepts, as the tax treatment of meal entertainment and sustenance is very different. Sustenance can be deductible for income tax purposes and can be exempt from FBT, whereas meal entertainment is not deductible unless it is subject to FBT. An example of sustenance can be when employees are traveling for business, for example. Broadly, there are 3 valuation methods for meal entertainment. The majority of our clients use actual cost or 50-50 split method. The third method is a 12-week register. We have clients in non-for-profit space who use this method very effectively. When the actual cost method is used, typically this method requires a higher level of detail in order to apply exemptions, but often can result in a lower taxable value. For this method, you need to consider only meal entertainment provided to employees and associates. Client entertainment is always exempt. Food and drink consumed on employers' business premises are always exempt. Minor benefits exemption can be applied for benefits which are under $300, inclusive of GST, provided to employees on the minor and infrequent basis. So when applying this exemption, don't forget to consider how frequently the benefit is being provided to employees. Many practitioners use a rule of thumb to exempt benefit when the benefit is provided to an employee, say, for less than 12 times a year. Each benefit is under $300, and their aggregate value is less than $1,000. However, minor benefits rule does not apply when meal entertainment is provided by tax-exempt bodies. This is important for our clients in not-for-profit organizations, as they cannot rely on the minor benefits rule. Also note that certain associated benefits have to be considered together as one aggregated benefit. And for example, travel and accommodation associated with meal entertainment. When using the 50-50 split method, it is a simpler method to use. So 50% of all meal entertainment costs are subject to FBT. When using this method, you have to take into account total meal entertainment, including all client entertainment provided on business premises, and you cannot rely on the minor benefits exemption. When using the 50-50 split method and 12-week register method, employer election to use this method should be on file for substantiation by the time of the lodgement of the FBT return. Now, I wanted to touch briefly on car parking fringe benefit, as I think it is likely to arise for more employers than in previous years. So it's important to consider this benefit and plan for it. Broadly, car parking fringe benefit arises when employer provides car parking to employees on premises which are leased or owned by the employer. Employee is parking his or her car for more than 4 hours during a business day, and within 1 kilometer radius of the employer premises, there is a commercial parking station which charges a rate of more than $10.40 for a full day parking. The full day parking is defined as to be at least 6 hours. And the criteria which we have on the slide here is not an exhaustive list. There is other criteria as well. What has changed from prior years is the definition of commercial parking station. The new definition effectively expanded the scope of what constitutes the commercial parking station. It now includes car parks in shopping centers, hospitals, airports, which were excluded from this definition before. The price structure in these car parks is typically prohibitive of parking for a full day and has a steep increase. So for example, the first 2 or 3 hours are free or low cost. And then the price for 6+ hours increases to more than $20 or $30. So if you have a car park like this within 1 kilometer radius of your business premises, and car parking is provided to employees on your business premises, it would be advisable to consider if car parking fringe benefit arises for your business. Previously, car parking fringe benefit has arisen mainly in CBD or inner city areas. Now, there are more and more shopping centers, car parks, which charge a rate greater than $10.40 for a full day. So businesses located in many suburban areas may be caught. Where it is determined that FBT liability exists, the employer is able to choose the valuation method which would provide the lowest value. as small businesses are likely to be caught for car parking fringe benefit, I wanted to remind you that there are some exemptions available. Small business car parking exemption is available when the following criteria is satisfied. Parking is not provided in a commercial car park. Employer is not a government body, a listed public company or a subsidiary of a listed public company. And either the employer's gross total income was less than 10 million or small business aggregated turnover was less than 50 million. When assessing this requirement, you need to consider the last completed income year before the relevant FBT year. So for FBT year 2024, you need to consider FY 2022 financials. Now, car parking benefits are exempt when provided to employees with disability. And there are some exempt employers who operate in not-for-profit space. Those employers includes scientific, religious, charitable, public educational institutions. Also note that car parking fringe benefit, by definition, car parking fringe benefit does not apply to residual vehicles. So residual vehicles are those vehicles with load carrying capacity of greater than 1 ton. Let's move on to reportable fringe benefits. Benefits with total taxable value of greater than 2,000 in fringe benefit year should be grossed up using the type 2 rate and reportable on employees' payment summaries or via single touch payroll. Those reportable benefits may affect employees' entitlement to various government subsidies or benefits, example, childcare subsidy. However, not all benefits are reportable benefits. Most common exclusions include meal entertainment, car parking, remote area benefits, and pool to shared cars. So those types of benefits don't need to be reported on employees' payment summaries. Now, in relation to pooled and shared cars, again, note that this exclusion does not apply to residual vehicles. So vehicles with carrying capacity of over 1 ton. So if employee is provided with a ute, and even if it's a pooled or shared car, is shared vehicle, it can be excluded from reportable benefits. Also, please don't forget that electric vehicles are reportable benefits despite being exempt from FBT. Now, the last topic which I wanted to cover off today was in relation to payroll tax disclosures. In our practice, we see a lot of errors in relation to reporting fringe benefits for payroll tax purposes. What we often see is that employers report the same amount as reportable benefits for payroll tax purposes. However, for payroll tax purposes, all benefits with taxable values should be grossed up using type 2 rate and reported for payroll tax purposes. So that is the benefits such as meal entertainment, car parking, shared vehicles, they all should be reported for payroll tax purposes. And if you just report to State Revenue Office what was reported on employees' payment summaries, you're likely to miss out on all those benefits, and it will be under disclosure for payroll tax purposes. However, please also note, on the other hand, electric vehicles, as they're exempt from FBT, they do not need to be reported for payroll tax purposes because they are FBT exempt. On that note, I'd like to thank you everyone for your attention. If you have any questions, please send them in and we will get back to you with our responses. Please don't hesitate to contact us or get in touch with your usual Pitcher Partners contact. Thank you very much.